A family can make more money than they have ever made before and still feel like they are falling behind. That is the strange part. On paper, the American middle class does not always look poor. Many households earn salaries that would have sounded comfortable 10 or 15 years ago. They have jobs, they pay taxes, they own cars, some own homes, some have retirement accounts, some have college degrees. But every month, the same quiet pattern repeats. The paycheck arrives. The mortgage or rent leaves. The insurance payment leaves. The car payment leaves. The childcare bill leaves. The medical bill, the credit card minimum, the student loan, the grocery order, the utility bill, they all leave. And by the time the household looks up, the income that once looked solid has become almost invisible. So maybe the question is not why the middle class feels poorer. Maybe the question is why income alone stopped measuring financial security. In 2024, the median household income in the United States was about $83,700. That number does not sound small. For many Americans, it sounds like a respectable income. It sounds like the kind of money that should allow a family to pay bills, save a little, take a modest vacation, replace a car when needed, and handle a medical expense without panic. But that number is gross income. It is not the amount that reaches the checking account. And even after taxes, the deeper issue is not just how much income remains. It is what that remaining income is expected to carry. A middle-class income used to mean more than cash flow. It meant margin. It meant that after paying for shelter, transportation, food, healthcare, and basic family needs, there was still some space left. Space for savings. Space for mistakes. Space for the future. But between 2015 and 2026, the general price level in the United States rose by roughly 41%. That means a household earning $60,000 in 2015 would need more than $84,000 in 2026 just to keep pace with broad inflation. And that is before accounting for the fact that the most important middle-class costs did not all move evenly. Housing moved differently. Insurance moved differently. Healthcare moved differently. Debt moved differently. Childcare moved differently. So the middle class is not simply dealing with higher prices. It is dealing with a new architecture of fixed costs. And fixed costs are different from normal spending. You can delay a restaurant meal. You can skip a vacation. You can buy fewer clothes. But you cannot skip rent. You cannot skip insurance. You cannot skip childcare if both parents need to work. You cannot ignore a medical premium. You cannot easily remove a car payment when your job, school, and grocery store are built around driving. This is where the feeling begins. Not in poverty, not in luxury, but in the narrow, anxious space between a good income and an unforgiving cost structure. And to understand that space, it helps to stop looking at averages and look at a household. Meet Elena and David Morales. They are fictional, but their situation is built from real patterns. Elena is 39. She is a registered nurse in Phoenix, Arizona. David is 41. He works in IT support for a regional logistics company. Together, they earn about $118,000 a year before taxes. To many people, that sounds comfortable, not rich, but stable. The kind of income that should place a family safely inside the middle class. They have 2 children. One is in elementary school. The younger one is still in daycare. After federal taxes, payroll taxes, health deductions, and retirement contributions that are smaller than they should be, their monthly take-home pay is about $7,180. Now look at the monthly structure. On screen, Elena and David Morales, Phoenix, Arizona combined gross income, $118,000. Estimated monthly take-home pay, $7,180. Monthly core costs. Rent, $1,874. Childcare, $1,450. Health insurance and out-of-pocket medical reserve, $770. Two car payments, $920 auto insurance, gas and maintenance, $760 student loans, $390 credit card minimums, $310 utilities, phones, and internet, $540 groceries and household basics, $1,150. Total core monthly costs, $8,164. Income minus fixed costs, $7,180. $8,164 equals negative $984. This is not a family buying yachts. This is not a family living recklessly. This is a family with two working adults, two children, ordinary cars, a rental home, health coverage, and the kind of debt that often comes from education, emergencies, or months when the math did not work. Their deficit is not created by one dramatic mistake. It is created by several normal bills becoming too large at the same time. That is what makes it uncomfortable. Because when people imagine financial trouble, they often imagine a bad decision, a luxury purchase, a gambling problem, a refusal to work. But in households like this, the problem is quieter. The problem is that the basic middle-class operating system now requires more cash than the household produces. So the family adapts. They lower the thermostat. They stop eating out. They delay dental work. They use one credit card to absorb the grocery spike. They tell themselves next month will be better. But next month begins with the same fixed bills. And this is where the middle-class squeeze becomes structural. Because once the fixed cost base is higher than the income base, discipline does not solve the equation. It only slows the damage. And the largest fixed cost usually begins with one word: housing. For decades, housing was the foundation of the middle-class bargain. You worked. You saved. You bought a modest home. The mortgage was large, but it was manageable. And over time, the home became both shelter and an asset. It was not just where the family lived. It was the machine that converted ordinary income into long-term stability. But that machine now works very differently depending on when you entered it. If you bought a home before prices and mortgage rates rose, you may be locked into a payment that feels almost protected from the present. If you are trying to buy now, you are facing the present directly. In May 2026, the median existing home sales price in the United States was about $429,000. Around the same time, the average 30-year fixed mortgage rate was close to 6.5%. With 20% down, the principal and interest payment alone on a median-priced home would be over $2,000 a month. But that is not the full cost. Add property taxes, add homeowners insurance, add maintenance, add utilities, add the repairs that arrive without asking permission. For many households, the real monthly cost can move closer to $3,000 or more, and the down payment itself has become a barrier. 20% down on a $429,000 home is more than $85,000. That is not a down payment for many families. That is a decade of attempted savings. So the middle class splits into two groups: those who bought earlier and are protected by timing, and those who arrived later and are punished by it. This creates a strange psychological divide. Two families can have similar incomes. They can live in the same city. They can work similar jobs. But one bought a house in 2018 with a low mortgage rate. The other rents in 2026 while trying to save for a down payment that keeps moving away. Their incomes may look similar. Their lives do not. And renting is not always the escape hatch. The average U.S. rent was close to $2,000 in 2026. In Phoenix, it was around $1,870. In Atlanta, around $2,100. In Miami, around $3,200. Renting gives flexibility, but it does not always give relief. And when rent consumes the first large piece of the paycheck, every other bill becomes more dangerous. A medical bill is no longer just a medical bill. A car repair is no longer just a car repair. A childcare increase is no longer just a childcare increase. Each one threatens the entire month. That is how housing turns from a cost into a gatekeeper. It decides who can save, who can move, who can have another child, who can leave a job, who can take a risk, who can wait. And once housing consumes too much of the household budget, the middle class begins to lose something more important than money. It loses optionality. But housing is only the first wall. Behind it is another cost that operates almost like a private tax on stability: insurance. Insurance is supposed to reduce fear. That is the promise. You pay every month so that one disaster does not destroy the household. Health insurance, auto insurance, homeowners insurance, renters insurance, life insurance, dental insurance, vision insurance. The idea is protection. But for many middle-class families, protection has become one of the reasons they feel financially exposed. Employer-sponsored family health coverage cost nearly $27,000 a year in 2025. Workers did not pay all of that directly, but the average worker contribution for family coverage was still thousands of dollars a year. And even after paying premiums, families may still face deductibles, co-pays, prescriptions, surprise bills, and procedures that require negotiation with an insurance system they barely understand. This creates one of the most uncomfortable features of modern middle-class life. You can be insured and still be afraid to use health care. A parent feels chest pain and wonders if it is serious enough for the emergency room. A child needs therapy, and the family checks whether the provider is in network. Someone needs a diagnostic test, but the household waits because the deductible has not been met. This is not the absence of insurance. It is the presence of insurance that still leaves financial uncertainty. Auto insurance adds another layer. A car is often not optional in American life. Many jobs, schools, supermarkets, clinics, and daycare centers are built around driving, so the family must own vehicles. The vehicles require financing. The vehicles require fuel. The vehicles require repairs. And then they require insurance. Every part of mobility becomes a monthly claim on income. Homeowners face a different version. In some states, insurance has become more expensive because of storms, wildfire risk, rebuilding costs, litigation, and the rising price of materials. Even people who own homes can feel less secure if the cost of protecting the home keeps rising. This is the second structural pressure. The middle class is paying more not only to live, but to reduce the risk of being financially ruined. And that means security itself has become expensive. That is a different kind of burden. Because when protection becomes unaffordable, people do not feel protected. They feel trapped between risk and payment. And when the household cannot absorb all of these payments from income, another system steps in: credit. Debt used to be associated with major purchases: a mortgage, a car, a college degree, maybe a business. But increasingly, debt also functions as a shock absorber for ordinary life. The grocery bill runs higher than expected. The car needs brakes. A child gets sick. The rent goes up. The electric bill spikes. The tax refund is smaller. The paycheck is delayed. So the credit card fills the gap. At first, this feels temporary. A few $100s this month, a few hundred next month. Then interest begins to do what interest does. It turns yesterday's shortfall into tomorrow's fixed cost. By the first quarter of 2026, total U.S. household debt was about $18.8 trillion. Mortgage debt was the largest piece, but credit card debt, auto loans, student loans, and home equity lines all carried their own pressure. This matters because debt changes the meaning of income. A household may earn $100,000, but if several $100s leave each month before any new decision is made, the household is no longer living on $100,000. It is living on what remains after the past has collected its share. This is why some middle-class families feel like they are always paying for an earlier version of themselves. A degree, a medical event, a move, a layoff, a divorce, a car they needed when the old one failed, a few months of inflation they could not absorb. Debt compresses time. It brings future income into the present. Then, later, it takes present income to pay for the past. That is why the middle class can look stable from the outside while feeling fragile from the inside. The house looks normal. The cars look normal. The job title sounds normal. The income sounds normal. But the household balance sheet is crowded. And once the balance sheet is crowded, every new cost becomes harder to carry. This is where the financial system becomes psychologically powerful. Not because every lender is predatory, not because every borrower is irresponsible, but because the system is built around monthly affordability. Can you make the payment? That is the central question. Not whether the household is becoming more secure, not whether the payment leaves enough margin, not whether the family can withstand two emergencies at once, just whether the payment clears. And when enough institutions ask only that question, the household can slowly become overcommitted while still appearing functional. The bills are paid. The credit score survives. The cars remain in the driveway. The children are cared for. The family looks middle class. But inside the month, there is almost no oxygen. And that leads to a deeper question. What happens when an economy measures access by payments, but households experience life through margin? Most middle-class families do not collapse all at once. They are narrowed gradually. A little less savings, a little more credit, a delayed repair, a skipped appointment, a smaller retirement contribution, a vacation canceled quietly, a second job considered, a move postponed, a child-related decision delayed because the math feels too tight. This is not just a financial pattern. It is a design pattern. Modern American life is built around subscription-like obligations. Mortgage, rent, phone, internet, car loan, insurance, streaming, software. Student loan, medical payment plan, daycare, utilities, HOA fee, gym membership if there is still room. Each one may be explainable. Each one may be rational. But together, they create a household that is always pre-committed. The paycheck does not arrive into freedom. It arrives into a queue, and almost everyone in that queue is automated. The bank pulls. The landlord pulls. The insurer pulls. The lender pulls. The utility pulls. The subscription pulls. The household gets whatever is left after the system has already taken its turn. That is why the middle class feels poorer than income suggests. Because income is visible, but claims on income are less visible. A salary can rise, but if fixed claims rise faster, the household does not feel richer. It feels busier, more productive, more exhausted, but not more secure. This is also why traditional personal finance language can feel inadequate. Make a budget. Cut unnecessary spending. Cook at home. Buy used. These things can help, but they do not fully answer a structural deficit, because a structural deficit is not caused by one bad category. It is caused when the cost of normal participation exceeds the income of normal work. That phrase matters. Normal participation. Not luxury. Participation. Living near work. Owning a reliable car. Having health coverage. Paying for childcare. Maintaining internet access. Saving for retirement. Keeping a phone. Having enough space for children. Avoiding medical bankruptcy. Having some emergency savings. These are not extravagances. They are the basic infrastructure of modern middle-class life. And if that infrastructure becomes too expensive, then the pressure shows up first as a private feeling. Shame, confusion, anxiety. The person asks, "Why can't I handle this?" But the better question may be, why does this require so much handling? That question is harder, because it moves the issue away from individual discipline and towards system design. And system design is slower, deeper, and more uncomfortable. Meet Sarah Kim. She is 45. She lives outside Atlanta. She is a project manager for a healthcare technology company. Her salary is $91,000 a year. She is single. She owns a townhouse she bought recently. She does not feel poor, but she also does not feel safe. After taxes, benefits, and a modest retirement contribution, Sarah brings home about $5,650 a month. On screen, Sarah Kim Atlanta metro area gross income, $91,000. Estimated monthly take-home pay, $5,650. Monthly core costs, mortgage, taxes, and homeowner's insurance, $2,850 HOA fee, $320 health insurance and medical out-of-pocket reserve, $430 car payment, $510 auto insurance, $520 utilities, phone, and internet, $610 groceries and household basics, $720 student loan payment, $280 credit card minimums, $210 support for aging parent, $500. Total core monthly costs, $6,950. Income minus fixed costs, $5,650. Sarah's case is different from Elena and David's. She does not have childcare. She does not have 2 car payments. She does not have a large family grocery bill. But she has a recent mortgage. She has an HOA. She has medical costs. She helps her mother. She has a student loan. She has a car because the region requires one. And she has a house that was supposed to represent success. This is one of the quiet contradictions of modern middle-class life. A person can own an asset and still feel cash poor. A homeowner may have equity on paper, but equity does not pay the grocery bill unless it is borrowed against or sold. A retirement account may be growing, but it does not reduce next month's insurance premium. A salary may sound impressive, but if the monthly structure is too tight, success begins to feel strangely illiquid. This is why many people do not trust their own financial reality. They look around and see signs of stability, a home, a job, a degree, a car, a retirement login. Then they look at the bank account and feel something else entirely. And the mismatch creates a specific kind of anxiety, not the panic of having nothing. The exhaustion of having something that still does not feel like enough. This is the emotional center of the middle-class squeeze. It is not only the fear of falling. It is the confusion of doing what you were told to do and still feeling exposed. The most powerful part of this pressure is that it arrives privately. The rent increase comes to your inbox. The insurance renewal comes to your mailbox. The medical bill comes with your name on it. The declined card happens at your checkout counter. The student loan auto draft hits your bank account. The car repair estimate is handed to you. So the problem feels individual. It feels like your budget, your choices, your planning, your failure. But millions of households are encountering similar patterns at the same time. That is the clue. When one household is struggling, it may be personal. When millions of households earning decent incomes feel fragile, it becomes structural. The structure includes housing supply that did not keep up with demand in many regions. It includes zoning rules that restrict what can be built and where. It includes healthcare costs that run through employers, insurers, providers, deductibles, networks, and billing systems. It includes higher interest rates that make homes, cars, and credit card balances more expensive to carry. It includes childcare markets where the service is expensive for parents, but often still underpaid for workers. It includes cities designed around cars, making transportation a requirement instead of a choice. It includes financial products that translate high prices into monthly payments, allowing households to access what they need while quietly reducing their future flexibility. None of this requires a villain in every case. That is what makes it harder to talk about. A landlord may be responding to property taxes, insurance, and market rents. A childcare center may be responding to labor costs, regulations, rent, and thin margins. A hospital may be negotiating with insurers inside a complex billing system. A bank may be pricing risk. A builder may be facing land costs, labor shortages, financing costs, and local restrictions. Each actor can explain its own price. But the household experiences the total, and the total is what breaks the margin. This is the difference between explanation and experience. The system can explain every bill. The family still has to pay all of them. And when every institution protects its own balance sheet, the household becomes the place where all pressures meet. That is why the middle class can feel poorer in a growing economy. The economy can expand. Asset values can rise. Corporate earnings can hold. Employment can remain solid. But the household may still feel worse if the cost of stability rises faster than the household's usable cash. A macroeconomic chart can say one thing. A checking account can say another. And the checking account is the chart people live inside. Financial stress is not only about money. It is about attention. When money is tight, the mind does not simply notice the problem once. It returns to it again and again. At the grocery store, at the gas pump. When the child asks about summer camp, when the dentist recommends a procedure, when the car makes a sound, when the rent renewal arrives, when the employer announces changes to benefits, the brain begins to run calculations in the background. Can we delay this? Can we split that payment? Which bill hits first? What can move to next month? Is the credit card balance too high? Should we cancel the trip? Can we risk not fixing the car yet? This is decision fatigue, not in the motivational poster sense, in the practical sense. A household under pressure must make more decisions about smaller amounts of money with higher consequences. That creates mental load, and mental load compounds. Chronic stress keeps the body's alarm system active. Cortisol and other stress hormones are useful in short bursts. They help the body respond to threats. But when the threat is not a predator or a storm, but a recurring bill cycle, the alarm does not fully turn off. The body can begin to treat ordinary life as a continuous emergency. This is why financial pressure often appears as irritability, poor sleep, exhaustion, forgetfulness, or a reduced ability to plan. The person may not say, "I am experiencing structural economic stress." They may say, "I am tired." They may say, "I can't focus." They may say, "I don't know why I'm angry." They may say nothing. And over time, the deepest cost is not only stress, it is the shrinking of the future. When a household is constantly solving the current month, long-term decisions become harder. Saving for retirement becomes abstract. Changing careers becomes too risky. Moving becomes too expensive. Having a child becomes a spreadsheet. Starting a business becomes unrealistic. Going back to school becomes another debt calculation. Even rest becomes difficult because rest feels financially irresponsible. This is how the middle class loses more than purchasing power. It loses time horizon. A stable middle class thinks in years. A squeezed middle class thinks in billing cycles. That may be the most important shift. Because when people lose the ability to plan long-term, they do not just feel poorer, they become easier to destabilize. It is tempting to say the answer is simply more income. And income matters. Of course it matters. A higher salary can reduce pressure. It can create breathing room. It can absorb shocks. But the middle-class anxiety of this era has revealed something more complicated. Income does not automatically create security if the cost structure expands to meet it. A raise can disappear into rent. A promotion can disappear into childcare. A second income can disappear into commuting, taxes, daycare, and exhaustion. A new job can require a move to a more expensive city. A larger paycheck can support a larger loan, which becomes a larger obligation. This is why many households feel like they are climbing a moving staircase. They are not standing still. They are working harder. They are earning more. They are adjusting. But the platform beneath them keeps rising. The price of entry keeps rising. The cost of mistakes keeps rising. The penalty for being late to homeownership keeps rising. The amount needed to feel safe keeps rising. So the emotional experience is not poverty in the traditional sense. It is instability inside respectability. And that is harder for people to name, because the old vocabulary does not fit well. They are not destitute. They are not wealthy. They are not irresponsible. They are not secure. They are somewhere in between. And that in-between state is where much of the modern American middle class now lives. Visible enough to be marketed to, stable enough to borrow, employed enough to keep paying, but stretched enough to feel that one disruption could change everything. In 1971, about 61% of Americans lived in middle-class households. By 2023, that share had fallen to about 51%. The middle did not disappear, but it became less dominant. And just as important, the experience of being middle class changed. The old middle class was not easy. It was never equal for everyone. It excluded many people. It depended on place, race, gender, union power, housing policy, education access, and timing. But for many households, it offered a recognizable path. Work could lead to ownership. Ownership could lead to stability. Stability could lead to retirement. That path still exists for some. But for others, it has become narrower, more expensive, and more dependent on when they entered the system. Did they buy a home before prices rose? Did they graduate before tuition debt grew? Did they lock in a low mortgage rate? Did they avoid a major medical event? Did they have family help? Did they live in a region where housing remained affordable? Did they choose a career that rose faster than inflation? Did they need childcare during the most expensive years? Did they have parents who needed financial support? These are not small differences. They are life-shaping differences, and many of them are not fully within individual control. That is why the middle-class story is becoming less about income and more about exposure. Exposure to housing inflation, exposure to medical risk, exposure to childcare costs, exposure to interest rates, exposure to regional inequality, exposure to debt, ex- exposure to family obligations, exposure to one badly timed event. The middle class still exists. But for many people, it feels less like a secure destination and more like a status that must be defended every month. That defense is tiring, and over time, tired households change the society around them. They delay children. They move away. They stop taking risks. They become more suspicious. They become less generous. They trust institutions less. They spend carefully in some areas and desperately in others. They appear normal from the outside, but internally, they are bracing. The American middle class does not feel poorer only because prices went up. It feels poorer because the meaning of a good income changed. A good income once suggested room to save, room to recover, room to make a mistake, room to imagine a future that was larger than the next bill. Now, for many households, a good income simply allows them to remain current. Current on rent, current on the mortgage, current on insurance, current on loans, current on the life they are expected to maintain. That is not the same as security. It is only the appearance of stability, renewed every 30 days. And if a society asks its middle class to live that way long enough, the question is not whether people will keep paying. Many will. The question is what kind of future they can still afford to believe in.